The bond market has been pretty volatile over the last 20 days since Reserve Bank of India did a midterm hike in interest rates. But to understand the current picture in the bond market, one will have to look back last 2 years to understand what were the underlying economic conditions and how they have changed over the course of the last 3, 4 months. In 2020, we were in a situation where the economy went under COVID. Reserve Bank of India had to support the economy through crisis level interest rate cuts, through huge liquidity injections, and that lasted for almost 2 years. Since January, we moved out of COVID, and therefore there was a need to neutralize interest rates. However, uh, the expectation of the market was that the interest rates will normalize in a very, very gradual manner, and possibly the Reserve Bank of India will not hike too much. In February, the Russia-Ukraine war started, and it led to a lot of supply-side inflationary pressures across the world. Also, as far as US was concerned, Fed realized that inflation in US was not transitory, and there were demand-side factors which led to high wage growth in US. And finally, Fed decided to tighten interest rates, and the path to tighten interest rates was very, very steep. Thereafter, I think the market's expectation as well as the RBI's reaction function changed, and we saw what happened on the first week of this month, where RBI increased interest rates by 40 basis points and also set course for increase in interest rates further in the policies ahead. I think the challenge for RBI right now is that they have a target of 3/4 of inflations, uh, to be within the band of 2 to 6%, and there's a possibility that the 3/4 average inflation may move higher than the 6% cap. Effectively, RBI therefore needs to tighten interest rates to an extent that demand, kind of normalizes to an extent. Of course, it's a more of a supply side situation, but to an extent, RBI will also have to manage demand so that inflationary expectations do not become entrenched. And that is the reason we expect that in the next three policies, RBI will hike interest rates and possibly take interest rates between 5.5 to 6%. Interest rates are always flowing in cycles. You will have like economic cycles which move from very slow economy to a fast-paced economy and then slowing economy again. Interest rates also keep on moving in a up and down manner. So when interest rates move up, normally when bond yields move up, they kind of lead to a price depreciation of the bond. And when bond yields move down, that leads to a price appreciation for bonds. So in a cycle where expectation is that interest rates are going to go up, bond yields generally tend to move higher, and that leads to price depreciation in bond, and which is where returns in the bonds get impacted negatively. On the other hand, when interest rates are cut, when bond yields are coming down, you will have a price appreciation in the bond, and therefore, the interest rates or the absolute returns would look much better in that scenario. We've been cognizant of this fact that bond yields would ultimately move up, and therefore, in all our commentaries, even our annual outlook, we've been very clear that the period ahead for bond has to be a period of caution. Even in terms of our valuation indices, which we come out with in our fact sheet every month, we've been very cautious over the period of the last 6, 8 months, and it was clear that at some point of time RBI would shift. The timing, of course, is always difficult to be very certain about, but the trajectory and the direction was very clear. And therefore, as far as our funds are concerned, we positioned our funds in line with our view. And of course, we've tried to be as defensive as possible in this period over the last 3 to 6 months. Also, in terms of products, I think it is very important how to position of your portfolio. And there are products which are available in the market which are you know uh, attuned to different market environments. In the rising interest rate scenario, products like floating rate instruments make a lot of sense. They are defensive and they also provide you upside as interest rates move up. Whereas in a downward interest rate cycle, one should look at fixed rate bonds. So selection of products also important, and we made sure that our portfolios have the right product selection under the current circumstances. So, as I said, in a rising interest rate scenario, the challenge is if you're holding a fixed rate bond, yield on the bond goes up, and when yield on the bond goes up, there's a price depreciation, and therefore the overall returns will get impacted. However, a corollary or absolute diametrically opposite product is a floating rate bond where your coupons are not fixed; they are linked to a benchmark, which may be a treasury bill or overnight MIBOR. And as the underlying index or benchmark moves, your coupons also shift. So in a rising interest rate scenario, if say a 3-month T-bill or a 6-month T-bill shifts from 4% to 5%, the coupons are also going to increase by 100 basis points. It's very similar to a floating rate home loan. As a home buyer, if I have to take a loan and my expectation is that interest rates are going to go up, I would normally choose a fixed rate loan, not a floating rate loan. However, if my expectation is otherwise, I would choose a floating rate loan. If I'm an investor, I would do exactly the opposite because I'm not a borrower, I'm investing. So, in a rising interest rate scenario, I would want to invest in a floating rate security, right? And when interest rates move up, my coupons will move up, my future cash flows will improve, and I'll not get impacted by the burden of having a fixated return when my opportunity costs are going up. So clearly, floating rate products are the products which are suitable to the clear current environment, and we believe that till the time we do not see RBI going into a rate cut scenario again, these instruments will make a lot of sense for investors. From a valuation perspective, these instruments are trading at very, very cheap valuations compared to a lot of other parts of the market, be it corporate bonds or be it government securities. These fixed rate government securities, these floating rate assets are much cheaper in terms of valuations. So both from a valuation perspective as well as from a cycle perspective, we like floating rate strategy a lot in the current context.